You know, you look at a market chart and it often just looks like absolute chaos, right? Lines everywhere, zigzags, red and green candles just flickering up and down. For anyone trying to actually time a trade, the sheer amount of noise is literally one of the most frustrating hurdles out there. You hear all this market jargon thrown around, stuff like BOS, CHH, and it kind of feels like this exclusive club where everyone else magically understands the language. And look, this confusion, it doesn't just cause headaches, it actively costs people real money when they misread the timing of a move. But today, in this explainer, we are decoding the market pivot. We're going to take all that visual chaos and turn it into clear, actionable, and highly structured signals.
There's a famous saying in the trading world, if you don't know this, you're trading blind. Think about the reality of that for a second. Just imagine the sheer sting of buying at what you think is the absolute perfect moment, maybe the very top of a rally, only to watch the market instantly crash against you the very next second. Or, the panic of selling your position in a dip right before the asset unexpectedly skyrockets. If you can't identify the foundational structural pivots, you aren't really strategizing. You are essentially just guessing. It's like driving at night with the headlights completely turned off. It is an incredibly dangerous way to navigate your capital. But that blind spot? Well, that disappears for us today.
Okay, let's dive into this. The market, it moves in this natural stair-step rhythm. Prices don't just travel in straight, uninterrupted lines. They push forward, they pull back to take a breath, and then they push again. And this brings us to a concept you're going to see absolutely everywhere, BOS, or break of structure. So a break of structure occurs when that established stair-step pattern confidently pushes past its previous high or low point. But why does this actually happen? It happens because buyer demand has officially and completely overtaken the historical seller supply at that specific price point. The market tests an old ceiling, and the buyers, they just smashed right through it. This breakout is the ultimate signal for trend continuation. Think of it as the market firmly stepping on the gas pedal. Imagine a stock consistently making new highs. Well, that break past the previous peak is basically the market stamping its passport for the next leg up. It's the asset validating its current direction, telling you loud and clear that the momentum is still pushing heavily in your favor. It completely clears up the anxiety of wondering, hey, is this temporary pullback the end of the line? Actually, surprisingly enough, once a break of structure is firmly confirmed on a higher time frame, trends can sustain themselves way longer than most retail traders expect. We're talking running for weeks or even months off a single structural validation. So as long as the breaks keep coming, the trend is healthy and totally intact.
But, no market steps up forever. Let's move to and see how this builds. Because eventually, that steady rhythm breaks. The momentum halts and the underlying psychology fundamentally shifts right before your eyes. We call this a change of character, or CHOC. And the name itself is pretty perfect, isn't it? The core character of the asset's price action is altering. It's a sharp, super noticeable change in behavior, where the market fails to make its anticipated next step, and instead, it cracks the very floor it just built.
This sudden shift, that signals a trend reversal. A change of character is the literal polar opposite of a continuing trend. It's the market aggressively pivoting, sending a definitive, undeniable signal that the current participants are just exhausted and the opposing side is aggressively taking over. So, if a downward trend suddenly breaks above its previous ceiling, the character of that trend has permanently changed. It's your early warning system. And let's be totally honest here, missing a CHOCH is usually the exact moment a trader's day is completely ruined, as they watch their profits just vanish in a matter of minutes. But if you're paying attention, it tells you the momentum you were tracking is dead, and a totally new direction is taking the wheel. And this brilliantly illustrates exactly how the chaos of the chart completely disappears into a simple, elegant binary when you put these two concepts together. Professional traders use this exact framework to strip all the emotion and guesswork out of their trading. On one hand, you have trend continuation. This is your validation, providing stability and the confidence to actually hold a position. On the other hand, you have the trend reversal. This is your alert, the definitive market pivot telling you to either get out or switch sides. A healthy moving market is really just a chronological sequence of continued structures. The exact moment that sequence fails and you get a change of character, boom, you have your pivot. You've successfully decoded the chart. Which brings us to the final, absolutely most critical question you need to ask yourself the very next time you look at an asset. Are you reading the pivots or are you still trading blind? You now possess the exact framework to read the market's true intentions. No more guessing, no more letting acronyms and jargon intimidate you. You have the tools to read the structure clearly. So as you prepare for your next move, look closely at those peaks and valleys. Watch for the continuation, anticipate the reversal, and ask yourself what the chart is really saying before you ever risk another dollar.